Okay, so we're calling this the end of solar, the rise of strategy, bonus depreciation, salt, and estate moves in 2025. Um, yeah, I must admit I was skeptical about the one big beautiful bill the first time it was proposed. How can it be big and beautiful? I wasn't sure if they could pull it off, but credit to them. They won a narrow victory, and it is a victory, I believe, for business owners and investors. So we're going to cover a few highlights of that and some ideas about how you might take advantage of particularly the bonus depreciation this year. It's going to be let's say 15 or 20 minutes before we open it up for Q&A. And as Sophie mentioned, I mean, feel free to put your questions in the Q&A. We're coming at you live from San Clemente, California today. Um, so we do these, about once a month, and we open this particular forum to everyone that knows us. Some of you may not be clients yet. Some of you may not be tax advisory clients yet, but you're welcome here. Hopefully you get something out of this. We'd love to do more for you. We really pride ourselves in a proactive approach to tax strategy development. And really the secret sauce is after the strategy is developed with the implementation. And that includes things like documentation, substantiation, irregular projection meetings, regular, unlimited consultations with the team, audit protection in some cases, and essentially everything that's necessary, from us to get the desired result. Um, Most of our clients, or on average, our clients experience a greater than 300% ROI on the work that we do for them relative to tax savings. Um, the way we do that is understanding how you make money, how you invest money, and what you want to happen to your money at the end of your life. We're going to talk sometimes about different investments that have a tax strategy component. And I want you to know that although I vetted the tax strategy, I'm not an investment advisor. However, can get you the details necessary to do your own due diligence, and would be happy to share my thoughts, uh, on the matter. But we're not an investment advisory firm; we're a tax advisory firm. A lot of the ideas
Jeremy,
come
can I?
from,
Sorry about that. At least on my end, it looks like we're still frozen on the first slide. Have you clicked through to other slides?
yeah.
Hmm. Then maybe do you want to try? All right, I see your mouse there. Okay, now it's changing. Now it's on the welcome due diligence project.
Okay, thank you for that, Sophie.
Yes, of course. Take it away.
All right. Um, so we're part of the due diligence project, and for those of you that don't know, this is an elite group of less than 500 CPA firms and family offices worldwide, and we share the same philosophy. That the tax code is a series of incentives for entrepreneurs, business owners, and real estate investors to do the things the government wants you to do, whether it's creating jobs, creating energy, creating housing units, and otherwise. We see the tax code as incentives for entrepreneurs to create an economic impact that is going to improve the overall, um, just quality and economy, uh, in our great country, the United States. Um, Although there's only 20% of Fortune 500 companies out there able to achieve zero taxes, they do so with CPA firms or tax advisory firms and family offices that are focused on tax advisory. We get this question a lot, like people want to blame their current CPA for their tax liability, but in most cases, in my experience, um, the CPA is just doing what they're paid to do, which is likely just preparing your tax returns or just doing your financial statements. Like you need to engage with a tax advisor for tax advisory services if you want to improve your tax situation. Um, we're a licensed regulated CPA firm. We know the code. We vetted the strategies, and we're prepared to deploy the best ones with you. And how we define the best is really within our peer group. We're looking for at least 20 firms over at least 5 months to rate the strategy 9 out of 10. So yeah, the ones that I talk about or suggest that you might consider have been through that process. Um, this is a recent update. So live on Amazon right now, we got um, the Zero Tax Strategy book. This has been something I've been working on for about the last year. And a lot of my favorite strategies are detailed in this book. So if you want more information, um, Sophie can get you these links. And the forward in there is actually written by Alex Sonkin, who is the founder of the Due Diligence Project. Okay, so the new law at a glance. We got the one big beautiful bill. Um, I tried to narrow it down to four highlights. 100% bonus depreciation not only is back, but it's been made permanent. This applies to assets with a useful life of less than 20 years. So not every asset, but um, it's permanent. And this was extremely popular in 2021. That was, I believe, the last year it was 100% bonus depreciation year. So that's back and it's permanent now. Also, a huge win for the uh, entrepreneur out there who wants to leave a legacy. The estate tax exemption is now locked in at $15 million per person. So that's if you're married, combined $30 million estate tax exemption, which means so if you structure it properly, upon the death of the last surviving spouse, um, assets with a or your net assets will not be exposed to estate tax unless they're over $30 million. That's a pretty high threshold. Before this change, they were it was going to sunset or not sunset necessarily, but it was going to go from 12 to 5. Now it's at $15 million locked in permanently per person for you and your spouse. The PTE elections keep SALT deductions alive. It's a little bit confusing there. What we're talking about is state and local tax. It was capped at $10,000 for individuals using Schedule A to deduct that particular expense. That's been raised to $40,000 for Schedule A, but we can still use the pass-through entity election. That's the PTE, and for those of you in like high tax states, that's still going to be the way to go. So they didn't take the PTE election away, but they did raise the SALT cap just to make it easier for those without businesses to deduct taxes that they were paying, whether it be state income taxes, property taxes, things like that. And then I know a lot of you have done solar investments in the past. Unfortunately, that is going away, but I believe that overall this is a really good bill because we got 100% bonus depreciation, the big estate tax exemption. Those are real wins right there. Um, and also we have clarity on what the tax brackets are going to be. Under the Tax Cuts and Jobs Act of 2017, um, that was passed as a temporary solution. Now those tax brackets have been made permanent, which is great. I mean, ultimately, investors want clarity on the financial metrics that are going into their ROI calculations, and we have that with the tax component with this bill. So a little bit more about bonus depreciation. I said previously that it is for assets with a useful life of less than 20 years. So what would that include? Most types of equipment, machinery, heavy vehicles, even luxury SUVs, if they have a certain gross vehicle weight rating of 6,000 pounds or more. Um, Software, believe it or not, has a 3-year useful life, and you can put it on a balance sheet, take bonus depreciation, and get a really great tax impact. Um, Oil and gas programs are great options to consider. Um, Equipment leasing deals, basically any sort of business that involves acquiring assets with a life of less than 20 years. Of course, this also applies to real estate investors through a vehicle called a cost segregation study. We're able to break out the property that has a less than 20-year life from the overall um, real estate value and take immediate depreciation on those things. So that's going to be another powerful thing that we can do with existing assets. It doesn't have to be necessarily a new asset in that case. Um, and this little graphic on the right here is an example of what's possible with a leveraged investment. Whether it be in some cases equipment rental, in some cases healthcare software. The ratio varies, but with a leveraged investment with the recourse debt and material participation, we can actually turn a $100,000 cash investment into a $400,000 or more tax deduction that may have a tax benefit greater than the cash that you put in. And we can achieve that in the first year. Those that I've talked to before know what I'm referring to, but if that doesn't make sense to you, get in touch with us and we can help you understand what that means precisely for your situation. And here's an example of a client that I'm working with now on essentially strategically acquiring some software units. This particular investment has a or uses 7-to-1 leverage, meaning that every $100,000 invested will generate a $700,000 tax loss through the magic of bonus depreciation. So 500,000 times 7, $3.5 million deduction in year one. That's going to save $1.2 million in taxes. So the estate planning in 2025 has gotten a lot easier. I know some of my clients were very concerned about this. They are very interested in leaving a legacy for their children and grandchildren and great grandchildren. and staring down the barrel at a 40% estate tax was very troubling to them. They'd started making moves, but I mean, the good news here is $15 million per person, locked in permanently. Uh, there is a couple moves that need to be made. Let me know, or drop a comment if you want to see a more in-depth webinar on the types of trusts and potentially family limited partnerships that you might use to preserve that, so that um, the last surviving spouse essentially is able to utilize not only their 15 million but their spouse's 15 million. It's not automatic. It does need to be structured, um, and the sooner that you get started, the better. It's going to lock in the value now, before any sort of inflationary growth. Um, and Yeah, so this is an example of a dynasty trust, I believe. It's also called a generation skipping trust, but um, we forecasted over a 9-figure tax savings over 3 generations, because we were not only able to preserve the asset value above or below $30 million in the first generation, but also the next generation and the generation after that. Um, so as I alluded to earlier, the SALT deduction increased from $10,000 to $40,000, which to be honest, it isn't too exciting. But I wanted to draw your attention to, like, you don't have to do it this way. A lot of you in California and New York and perhaps Massachusetts, you're paying a lot more state and local taxes than $40,000. So this, although it's better, like, it's still not the solution that you want. So if you have a business, most states now are allowing for the pass through entity deduction, which essentially means you can pay the state and local taxes through your business, and there's no limit on that. So this wasn't specifically in the big bill, but is definitely something that we work with a lot of our clients on, like how to take advantage of this pass through entity deduction for state and local taxes. And what a lot of people probably didn't catch with the analysis of the bill, or what's hitting the news, is it still phases out. So if you're making over $500,000, that $40,000 of PTE, it's going to get phased out once you're over $500,000. The good news, of course, it's indexed for inflation, as it should be. I believe we're definitely entering an inflationary regime. Um, so yeah. Um, so yeah, sorry, all you solar people out there. It was a good run while it lasted. It did a lot of good with that strategy, but it's time to move on. It's time to find something else. And we've got options for you. I'll hit on it in a second, or actually, I'll hit on it right now. So I mentioned the healthcare software strategy earlier. That's been very popular. Um, I did a separate webinar on that. If you want more information on that, please let us know. We can get you a copy of the webinar, um, to start that process, and perhaps more information if you're an existing client. We have a data room with what you would need to conduct due diligence on that strategy. Also, came across my desk a couple weeks ago a really exciting opportunity to invest in a Mark Wahlberg film. I had a chance to look at the numbers on this last week, and it looks good. The storyline is engaging, to say the least. It is a cross between a mob movie and a civil rights era crime story. Uh, Mark Wahlberg is, of course, very well known. It's got a pretty good cast around him. We got 4-to-1 leverage on this. I do expect it will sell out pretty quickly. I would say if you're interested in this, like definitely get in touch with us. If not this week, next week, and start the process. We can get you access to a data room. Um, we can arrange a private screening of the trailer, and it looks like a pretty cool flick. And because of the storyline, it's not based on current events. It's based on a really significant historical period in our country. It has the potential to be something that would generate royalties for quite some time. Um, the budget on it was $32 million. They've already raised $10 million of tax credits and $18 million of pre-sales, and it hasn't even hit the box office yet. So it's one of these rare cases where the film will be fully funded, uh, in all likelihood, by the time that it is released to the box office. Um, the healthcare software RTU is the example that I gave previously. Um, oil and gas, I think, is a potential alternative to solar. Um, equipment rental, whether that's heavy vehicles or smart industrial equipment, could also be good. Or if you have use for a large truck or even a luxury SUV, um, that could also be a good bridge strategy this year, now that we have 100% bonus depreciation. So to recap, we got bonus depreciation locked in 100%. This is for assets with a useful life of 20 years or less. Estate planning or estate tax planning just became a lot easier. $30 million per married couple. If structured properly, your assets will not be exposed to the 40% federal estate tax. We got the SALT workaround still exists. We call it the pass-through entity election. That's in most cases going to be the way to go if you're in a high tax state like California, New York, or Massachusetts. And then beyond solar, we've got film, oil, healthcare, equipment rental, and others. So get in touch with us sooner rather than later. Just remember that these alternative strategies that I talk about, sometimes I refer to them as leveraged investments. The key is, beyond understanding the risk reward profile, it's also understanding the difference between active and passive income. So whether it's a W-2 or a K-1 from your business that has your share of the profits on it, that is coming out as ordinary income. That is active income. Um, the investments that I've described in this webinar, um, if you did nothing else besides make the investment, it would come out as a passive loss. And the rule is passive losses can only offset passive income. So the key to these strategies is converting that passive loss into an active loss so that you can actually experience or realize the tax benefits. And we do that with your documentation of how much time that you spend in that activity. And except for real estate, there's one exception where real estate would apply in this situation for like short-term rentals. If the average rental period is less than 7 days, 100 hours is all you need. But that 100-hour rule, it applies to healthcare software, it applies to film financing, leveraged equipment rental, and a lot of the other strategies that I talk about are eligible to convert or be converted from passive loss to active loss with only 100 hours of material participation. So like that's the key.
Mhm.
Just wrapping up here, like I always like to remind myself and anybody who's watching this, or if you've stuck with us this far, um, like what our focus is. Like we are truly passionate about empowering entrepreneurs to realize, achieve, and live their dreams, and we do that with world-class virtual family office teams. Our niche is developing, implementing, and maintaining customized wealth and tax strategies that lead to multi-generational relationships. We do that in collaboration with experts in other fields, whether it's asset protection attorneys, estate planning attorneys, um, certain investment specialists, wealth managers, insurance strategists. It takes a team to deliver the result, and we're enthusiastic about collaborating with them. And our BHAG, Big Hairy Audacious goal, by 2030, we will have empowered entrepreneurs to redirect over $1 billion of taxes to business and local community. I truly believe that entrepreneurs are the best allocators of capital in the world and will make the world a better place if they can keep the money out of Washington, D.C. and in their local communities. So that's why we do this. So if you're a current client, your advisor and I are well informed about these changes and are able to answer your questions and get you more information about all of these. If you're not yet a client or you're just a tax only client, we'd be happy to uh, explain how to engage at a higher level so that you can have access to these powerful solutions. And we thank you wholeheartedly for making it this far and look forward to continuing to develop our relationship with you.